I'm gonna kick things off here. We are approaching critical mass, so I'll start off by saying hello, good morning, good afternoon, wherever you are in the world. Welcome to today's webinar on the topic of Perpetual KYC. In this webinar, we are going to discuss what Perpetual KYC is, the benefits of moving to a Perpetual KYC environment, and the challenges of doing so as well. Before we jump into this rather weighty, meaty topic, we're going to do a couple of introductions on the next page between myself and my co-presenter, Silvia Amoros. So I shall go first. So my name is Owen Davis. I am a director here at Sionic. I work in the banking and markets practice in the client lifecycle management or KYC team. I've been with Sionic for around about 18 months or so. Before that, I have somewhat extensive experience from a change and transformation perspective, with a particular focus on financial crime, in particularly KYC and client lifecycle management. Before joining Sionic, I spent a number of years at Deutsche Bank, working within their asset management division, DWS, where I was the head of FinCrime Change. What we work with in Sionic is a focus upon the advisory piece for our clients in the CLM space, target operating model, remediation, system and implementation, change and transformation, or generally, which is obviously my sort of sweet spot as an individual from my experience. And then we also provide remediation and managed services, managed service activities to our clients as well. So that's a little bit about me, my background, and what I do here at Sionic. Silvia, I'll hand over to you.
Thank you, Owen. Good morning, afternoon, everyone. It is great to see some known faces from our previous webinars coming back for more. I'm really looking forward to meet the new joiners. It is a pleasure being here today to discuss with my colleague Owen one of the topics that within CLM has been front and center when looking for efficiencies, synergies, cost reductions, etc. My name is Silvia Amoros, and I am a partner at Sionic, focusing for the last 10 years in client lifecycle management, processes, systems, efficiencies, as well as the operational impact of new regulations. Within this change and transformation role in CLM, I have been focusing in the complete end-to-end redesign of operating models, ensuring speedier client review processes by implementing and defining perpetual or ongoing due diligence policies and procedures, definition, design of global customer due diligence policies and programs of work, RFPs for system selection, remediation exercises, such as well as business process outsourcing or managed service, which we have created different hubs for that. And if you recall, that was our previous webinar topic. So looking forward to this conversation, Owen, and I'll hand it over to you to kick off.
Cool. Thank you very much, Silvia. So I think the first place, as any of these webinars, was where do we start? And the simplest place for us to start there is a definition, really. I think Perpetual KYC probably means different things to different people, but our view on it here is that in very simplistic terms, it is a continual review of the identities and activities of your client base based on specific triggers or events, rather than a specified amount of elapsed time, which is what happens under a periodic refresh model, which is, I guess, the more traditional model that we have seen out there. So if the periodic refresh is the past or the current, Perpetual KYC is certainly the future. Now, what we sort of laid out there in terms of that definition, it's almost a little bit simplistic, and in many ways sort of too simplistic. It really looks and says, you know, this is the time saver for you, okay? We don't have to go through this refresh every 1, 3, 5 years from a European perspective, generally speaking, or 1, 2, 3, if that was in a kind of a North American context. That's not really what we're kind of getting to here. There's a kind of a broader point. Like if we look at the geopolitical context at the moment, we live in a time of extreme change. The invasion of Ukraine 18 months ago has really shifted the dial in terms of understanding our client base and where our risks are, and also what people's risk appetite is. You know, you've seen certain businesses have had to shut because of sanctions in certain locations as a result of that. COVID, the Panama Papers, all of these things exist in a world where, as financial services professionals, we can't just ignore. We're not in a little bubble that we can kind of compartmentalize that and ignore it. It's actually very part of what we do. And that has created some significant challenges for organizations from a financial crime perspective. That existing kind of model of the periodic refresh doesn't allow you to capture risks up front. Everything is done not in a timely manner. Your understanding of your customers and your client base is almost after the fact. What Perpetual KYC gives you the opportunity to do is to review those outdated processes and replace them with something that is more current, up to the date, and of the minute, okay? So when we talk about Perpetual KYC, we actually look at it as providing an enhanced risk management environment, okay? Every firm needs to manage the risks that they face, obviously to the tune of their own risk appetite, but certainly trying to do that in an ever-changing geopolitical environment is something that is incredibly challenging to do. What Perpetual KYC will allow you to do is revolutionize how organizations use the data that they have to get a greater understanding of the risk that they have, and also use that data to drive profitability and revenue on a per client basis, but also on a per business basis, along with the additional operational benefit, shall we say, of removing inefficiencies, because there is a known and well understood inefficiency in a periodic review or a periodic refresh environment, and some of those bottlenecks as well. And I think the final point that's important in understanding, which we will delve into in more detail as we go through this conversation, is really around the customer experience. Anybody here can attest to good and bad customer experience in any particular retail guise. And it is something that organizations and financial services firms really struggle with, how to keep the customer happy and how to make their experience better. And particularly at time of onboarding, which is your first view of a client. And Perpetual KYC actually provides an opportunity to enhance that as well, along with the other benefits that we've alluded to here, which we're going to discuss in more detail as we push on through.
So if we think about Perpetual KYC, how long we've been speaking about it and why now? As mentioned before, Perpetual KYC is something that we, within the AML and operations teams, we have been speaking for a few years now. But now is when we are seeing effective implementation of PKYC policies, ongoing due diligence policies, however we want to call it. It is therefore now a reality that is addressing some of the key challenges that standard KYC processes has implied for over the last, I believe, 12, 14 years, right, Owen? Yep. We believe that there are three main reasons for Perpetual KYC being implemented in many of our clients right now. The first reason we believe is this post-remediation landscape that we're living in. I think many of us have lived, suffered, and drowned in big remediation exercises, challenges, but then completion as well. And now is where we have an opportunity to update our policies and seek for those efficiencies and seek for those changes, both in policies and mindset. So that change in landscape has actually provided a change in our mindset as well, and how we want to risk assess our clients. The second main reason why we look at Perpetual KYC as a reality now is the efficiency drive. We have been spending too many economic and operational resources, and now that regulations and rules are more stable, not so changing continuously, we can focus on seeking those efficiencies in our processes, right? And ensuring that these regulatory and compliance requirements provides us with a competitive advantage instead of implying just a cost. Which linked to this is one of our favorite topics, right, of the cost of onboarding, the true cost of onboarding. So I think now is when we can actually do a good exercise on that efficiency within our KYC process. And lastly, the third reason where we believe Perpetual KYC is now a reality would be the technology advances. So we see that in the case of ongoing reviews of client profiles, the number of triggers or events that have a material effect on the risk assessment of the client that banks are required to assess is already high, right? So it can be an addition of an associated party, the change of a CEO, a PEP. Another key component of Perpetual KYC is understanding the transactional activity and proactively reacting to unexpected patterns. So what is the alternative to managing Perpetual KYC compliance with static client profiles, as Owen was saying, that have to be updated? With technology and automation, firms can ensure that client profiles are updated automatically or as automatic as possible, and in real time, allowing for that continuous monitoring of the risk, as Owen was saying, to be doing that KYC, that risk assessment on a timely manner, instead of a snapshot of that risk assessment in a moment of time, right? Through API and integrations with third-party providers for entity data screening, AML, transaction monitoring systems, these financial institutions, our clients, can automate and streamline those KYC events and detect and react to those changes in client data when they arise, while capturing the data that they need to report it effectively. Therefore, these technology advances are now supporting what we consider is effective perpetual KYC. So I think, Owen, if we just move on directly to the key benefits of what perpetual KYC is providing to us, I'll provide a brief summary, and then we will drill down into each one of them. But I think the broad benefits of a perpetual KYC policy in place and processes with all these systems aligning to it as well are increased profitability, which is linked to that efficiency drive that we were discussing before. Data enhancement, so we will discuss the quality of the data and how we will enhance that. Risk reduction, so reduce the risk when onboarding our clients and when we refresh our clients. End to remediation, so trying to reduce the possibility of having the requirement of another remediation. And enhanced customer experience, which is one of the focuses now after this post-remediation landscape, as we were discussing. So we're going to start this going through each one of the benefits. Owen?
Thank you, Sylvia. So those of you that have been in our webinars before will know that a recurring sort of theme as we've gone through this is the sort of the shift in mindset from a broader, if you take a step back from perpetual KYC even, but look at CLM and KYC as a whole and try to move on from that as being a pure cost center and a pure operational cost to organizations, and looking at it as well, you know, if there's ways that we can improve that and everything that Sylvia has talked about with technology and efficiencies, what will that do for us from a bottom line perspective? Will that reduce our costs? Will that enable us to run things in a more efficient manner and also drive potential revenue opportunities as well, which is something that we are going to come to as we get down through this. But if you look specifically at profitability here, KYC has traditionally been incredibly costly, and the cost of it has only increased exponentially over that sort of 12 to 14-year period that Sylvia has alluded to earlier, okay? So you go from a situation where firms did KYC either not at all or very badly or light touch, even for want of a better description, to places where after regulatory censure, you go to the dial switches from one end to another, okay? And the argument that's always been given to me throughout my career was, well, if you think compliance is costly, try non-compliance, okay? We can all look around at the various organizations within the industry that have been fined, that have had deferred prosecution agreements, Section 166 is imposed, you know, and even if there isn't an actual fine, the requirement to remediate, you know, be that just a set of KYC files or be that a broader AML framework remediation, it is significant around that, okay? So what we talk about here when we look at increased profitability is how can we make changes within our operating model which will reduce the costs and thus drive up the profitability that we see from each of these centers, okay? I think one of the key points here that we see is the removal of the periodic reviews. There's a significant overhead for organizations in carrying out periodic reviews across the specific timeframes that we alluded to earlier in, you know, 1, 2, 3 and 1, 3, 5, right? And, you know, that applies across retail organizations, you know, more retail banking type organizations who, you know, will have a lower risk customer base just by nature of them being by virtue of them being individuals, notwithstanding sanctions, etc. And also to those that have the more complex sort of corporate type, you know, legal entity client base, which obviously requires a significant piece of extra work that needs to be done as we come to review. I know from work that we have done, specifically in conversations we've had with clients, and I know from my own experience in prior roles, it takes almost 4 weeks to complete cradle to grave a periodic review, right? That's one periodic review. Firms have tens of thousands of these to be done in a given calendar year, right? So there's significant cost that's associated with KYC. That cost is headcount. There's the infrastructure associated with that through the various tools that are there. And then on top of that, we have this shifting regulations that happen. Okay, I know COVID has kind of put a little bit of a pause to the EU's rush to get through various anti-money laundering directives. But, you know, number 7, number 8, number 9, etc., they're all going to come down the track at a given point in time. And firms need to keep up to date with that, right? If you're using the traditional KYC model, that just becomes more and more costly. Everything we've alluded to earlier in terms of moving to KYC, that sort of continual review, the technology and the data that will support that removes the need to do that. Okay, it becomes significantly easier to get your understanding of the customer up to date, to manage your risk, and also to keep the costs lower. Right, I think we can all think of examples of organizations who have had maybe not tens of thousands, but certainly thousands of people processing periodic reviews and onboarding new clients. The ability to do that in a timely and efficient manner reduces the operating costs on both a per client and indeed a per business basis, and will only serve to help increase profitability for an organization. So we sort of see that, you know, there is opportunities here to drive out profitability for organizations, and also that kind of enhanced understanding of client behavior that we get through this data will help drive revenue opportunities. And we've obviously seen what we've listed here as 1 to 5 in terms of the benefits, and data is what we're going to speak to on the next slide, right? And I think that's one of the key benefits as we go on to the next piece, please, Nat, is around data and its importance. And any of us, you know, we live in the GDPR world. We're all familiar. You go on a website, in very simple terms, you have to accept cookies, or you can manage the cookies and read everything. But, you know, we are at a risk now. It's all about data. Your data is important. You have a right to see your personal data, okay? The world has evolved rapidly on the data topic in the last sort of 15 to 20 years, certainly since I, you know, have joined the professional ranks out of university. There's been a sea change in what we've seen in that period around the use of data. It has now become ultimately key to everything that we do, okay? Organizations that engage with clients, be they good actors or bad actors, potentially, need to understand their data. Without that data, we just cannot function as organizations, right? It keeps us all going. It is, as the slide said, it is the new oil. And it certainly greases the wheels of what we have as an organization. And the key thing about that data is any of the systems that we have in place within the KYC, the CLM world, they really come back to the old adage of garbage in, garbage out. Okay, so if we have bad data, right, or out of date data, as in a traditional KYC model, well, then we're not actually actively capturing the risk. We don't really know who our clients are. You know, if we have a low risk client, we're going to review that every 5 years. Okay. Is it still the same UBO? Is the IBO still the same? Has the ownership structure changed? We're not aware of any of that. So data is of critical importance as we try to understand the risk that we carry and whether or not organizations really want to maintain those relationships or not. Because obviously, you know, people's risk appetites can change. I talked at the top of this webinar about geopolitical risk. I think people's risk appetite rapidly changed overnight in certain institutions on the 22nd of February 2022. Given what happened in those days. So, you know, we can see that the ability to react or to be proactive here is critical in the environment in which we live now. Now, one of the things that Perpetual KYC will give you is that enhanced data, because you are constantly monitoring, you are screening every single day, you are looking for new alerts, for new hits. You have a greater understanding of what it is that your clients, the risk that your client is presenting. And that is also aligned to the transactional piece as well. So I sort of touched on this, I think above, like that transactional data is something that firms have historically looked at, you know, on a pattern basis. So almost after the fact, okay? When you move into the Perpetual KYC data, you're looking at that as it happens, okay? We can see, even as retail customers ourselves, if you use your debit card too often, your bank, from a fraud perspective, will put a block on that, okay? Because that's what they see as patterns. When debit cards get stolen, people start to tap a little bit too often, right? So Perpetual KYC and what that does is actually help you understand the transactions that your clients are engaging in, what those patterns of behaviors are, and that actually starts to drive revenue generating opportunities, because we do start to understand how clients react to certain situations, what they do when the market drops 10%, what products they will buy, etc. And it drives revenue opportunities. Again, comes back to the point about trying to turn KYC and CLM not from a cost center, but to a profit center, to see how it can actually help to drive our businesses further forward and not be seen as just a bit of a box ticking, compliance-led exercise that's just going to take up time for our people and we're not actually going to enjoy it and it's not any benefit to me, okay? That mindset is obviously clearly shifting over time, and I think Perpetual KYC actually just helps to speed that mindset and start to drive out, you know, those insights that we get from clients, whereas the retrospective data in the periodic refresh, we're just not going to be able to get that type of data there, because it's almost stale by the time that we see it. The flip side of that is when you look at it from a risk management perspective and you start to say abnormalities. I've given the simple example of your debit card being stopped when you tap too often. Okay, we can start to see any abnormalities if a customer invests in something that's really out of character for them. You know, what we would have expected them to invest in over a course of a given 12, 18, 24-month period, however a review cycle or transactional review cycle is, that starts to get flagged as well. So we do start to understand, is there something changed about this customer? Do we need to go and trigger an EDR here because they've gone and invested in something that's completely out of sync for the relationship that they've initially engaged us with? So that data piece has a number of significant benefits to an organization in terms of cleaning the data, looking at enhanced data sources, getting it more up to date, refreshed, as soon as we possibly can. Trying to stop these AML failings that we've seen in the past. A lot of the time, that comes down to poor data, right? And not actually understanding, who our clients are, okay? Because it's a gap in the control environment. And I think if that control environment can actually be enhanced and be strengthened, it provides comfort to those in the second line that are trying to, prevent financial crime occurring or the facilitation of financial crime. But then also, from a first line perspective, those that are actually accountable for these client relationships can be more comfortable that the controls are in place to capture that. But then also try to leverage that data to see, hey, how can we actually try and grow these client relationships? Is there a way that we can use the data that we have because we're getting it, it's fresh each day to determine, better revenue generation, sales opportunities for those particular clients?
I can't agree more, Owen. And just linked to that, now is the moment, right? Now with those technology advances that we were discussing earlier, we can actually use that data, that enhanced data, that clean data that is up to date in different processes. So it's not going to be a benefit just for our PKYC or our KYC process and our refresh process. It's actually going to be used for other purposes as well, right?
Mm-hmm.
So I totally agree. Another benefit of having a perpetual KYC model in place would be the risk reduction. So as Owen was mentioning before, it provides us with not only that risk reduction, but the effective risk management of our clients. Accurate calculation of risk exposure to a given client requires data to be as up to date, as Owen was saying, and accurate as possible. In a scenario where a firm has a low-risk client, a full KYC check may only be carried out every, what you were saying, Owen, 5 years, 3 years?
3 years.
Yep. If we're being aggressive or North American, that makes you entirely reliant upon that client situation remaining in that, remaining static for those 5 years or those 3 years, right? The KYC review is outdated as soon as it is completed and may not accurately capture the risk associated with a given client. So in summary, standard KYC processing takes a static snapshot, as we were saying before, of the client's risk at a given point in time, which increases the bank's risk significantly. So as you were saying before, this is actually not done on a timely manner, but by having that enhanced data, we will be able to have those event-driven reviews, if we may, to make sure we have an ongoing risk assessment of our clients. Assessing risk should never be seen as one-time exercise. It must be something that firms should be monitoring on a constant basis. The ever-evolving regulatory landscape demands that firms no longer cut corners when determining how risky their customer base is. Risk is not a topic where any firm can afford a loose approach, and the best approach to managing it appropriately is to let the data, as Owen was saying, lead the way. So I think this is very important for our PKYC operating model. And this is going to drive how we risk manage our clients moving forward. Another benefit of having perpetual KYC, I know, Owen, you said it again a few times, and I said it before, but no more remediation. So if we go to the next slide, we will see that remediation of customer files is an expensive business, very expensive business, increasing significantly the financial institution's KYC cost. Of course, depending on the sophistication and efficiency of the systems and processes, but it's increasing the cost. So as Owen was saying, we're not doing that shift in moving from cost to profit center. We're actually staying in the cost center and we're increasing it. So remediation is not going to provide us any benefit at all, right? By implementing perpetual KYC, firms will avoid the need of client remediation projects in the future, as customer data will be updated on an ongoing basis, when necessary, of course, but on an ongoing basis. Perpetual KYC is therefore a valuable tool in tightening our AML compliance overall and avoiding regulatory sanctions associated with poor data quality and controls. So going back to one of our main points or themes within our webinars, risk and control is going to drive our decisions moving forward. It's going to drive how we update our policies, how we implement our ongoing due diligence programs, and therefore it's going to help us have the view of our clients as up to date as possible and reduce our cost moving forward. So I think avoiding remediation exercises and avoiding that increasing cost is something that we don't really have a choice anymore, right? We just need to make sure we are not in the scenario where we were 6-7 years ago, where we were in constant remediation exercises. So I think this provides a full, set of benefits that our clients will have having that perpetual KYC. Oh, and if you want to go through the enhanced customer experience benefit.
Yes, please. Thank you, Sylvia. Look, we've talked about this previously on other webinars, okay? Right, client experience, it's very simple. Look, if you don't have clients, you don't have a business, right? Okay, you're gonna run out of cash very quickly, right? You won't exist. And I've alluded earlier in this conversation, and Sylvia talked to it as well, about the poor client experience, the amount of time it takes us to be onboarded as a client. There's very simple examples here. You can open an app and open a bank account within a couple of minutes, or you can go into a branch of a more standard high street, as they say in the UK, or one of the major retail branches across the globe, and it can take weeks to do, okay, to filling out a form, right? So, we see, even at that very simple example, how the startups have actually driven this enhanced customer experience, the more digitalized focused on that. If you were looking at the periodic refresh approach, I talked earlier about 4 weeks to complete a regular review from a time frame. It's laborious. It's back and forth. I have to if I'm the client, I have to send the documents to Sylvia, within the firm. Sylvia says, oh no, that's not good enough. You need a more up-to-date proof of address within the last number of months per policy, etc. It just creates a tension. And all it will do, whatever the cycle is, if it's every 1 year for a high-risk client, every 2-3 years for medium, 3 to 5 for low, providing all that paraphernalia, the PDFs, the passports, etc., takes an inordinate amount of time, and it creates tension. People start to lose a little bit of trust with the firms. Okay, the customer experience really starts to fray, and it puts a lot of pressure on the relationship managers then to try to rescue that, because the feedback from the client won't go to the KYC ops team; it'll go to the relationship manager, who's then going to be required to start to wheel that back in. From the firm's perspective, it's also inefficient. It's a complete and utter waste of resources trying to do that. Okay, having people, chase people down to get an updated passport, an updated company formation documents, or if things have changed for a given legal entity, not an efficient use of time or resources, as we talked about previously. What we sort of see here as well, the other factor that is linked to this is really employee experience. The pandemic has shifted a lot of things. I talked about its impact upon, AML earlier, but it's actually from employees as well. People are in what was, I guess, termed the Great Resignation, although, that's more of a kind of United States term, is that people are looking for better ways of working. Life has changed. We don't all come to an office 5 days a week. The employee experience drives into this as well. If they're doing stuff like that that's taken 4 weeks, they're not going to enjoy it either. And that's going to be reflected in the service that they're going to give out to the clients, which again won't reflect well on the firm. The advantage here with Perpetual KYC model is that you move away from that. Okay, you don't have to go through this 4-week window every couple of years to update the documents as part of the periodic review. You only operate in an EDR-based environment, which is driven by triggers by significant or material changes in the risk that a client actually carries at any given risk level. That is a real game changer, okay, for clients, from the experience that they get, the service that they get from their financial services, but also actually for the organizations as well. The technology starts to drive operational efficiencies. It can potentially start to drive headcount efficiencies too. And what it also will start to do is reflect the positive benefit of the onboarding teams within the organization. Onboarding teams have been probably unfairly tarred with the fact that they are the ones who are creating these problems in terms of onboarding, when actually they're just following the processes that are laid out for them, that are really driven off regulation. That doesn't necessarily feed down into organizations, but we can see that through the use of this, it highlights the positive impact of the onboarding function, of the periodic review function, depending on the size of the organization, and really starts to enhance that customer experience to ensure that there's less touch points between the client and the organization for, your standard kind of KYC AML checks, because a lot of that is done in the background. It's done on a trigger basis, and people really appreciate having the ability to have less of those touch points as we go forward. So I think that concludes the benefits there. So we're actually going to start to look at the flip side of that now. And I'll hand over to Sylvia, who'll talk a little bit about some of the challenges that are with this.
Thank you for letting me the nice part of the story, right? So yeah, as any change, right, it comes with challenges, and we wanted to just share some of the challenges that we have faced in different implementations of PKYC policies. One of them is cost, like always, right? Any change implies a cost. It has cost from an operational perspective. It has cost from an economic perspective, and of course from a kind of a mindset perspective. Then a regulatory approval. Another one of the challenges would be sometimes we require regulatory or internal approvals, and this can require time and can require effort, and also imply a different time to market, which is the next challenge. If we need to take some time to have our policy in place, and we need to do changes, and sometimes these changes are going to bring technology changes as well, which will increase the cost and will increase the time to market, we might face some of the issues that we are finding with our standard KYC process, right? So therefore, the benefits can take a little longer to see the value from. Then the shift in mindset. So again, it's another change, and that's a shift in the way we operate and the way we work. So not only looking at our clients in the same way we're looking at them now, it's like I do KYC, I do the due diligence once, I risk assess my client once, and I forget about it. This is actually an effort of maintaining that relationship as well, doing client outreach properly, because if it's going to be event driven, then we might need to change our mindset on how we interact with our clients, or even do it a little bit more automated than now. So this is going to be another one of the challenges. And lastly, we will need to provide those policy changes and processes changes that will imply our new process. So once we define the operating model for this process, we will see that changes are required, not only from a document perspective in terms of policy documents, manuals, etc., but also in those frameworks, in the governance, in the way we work together as an ops team. We will need to make sure that is properly, live documented and trained within our teams. Again, I think none of these challenges are different than for any change, Owen, in any financial institution. So I think all these are common for all of us, but we just didn't want to provide you with, the positive story. It always comes with some challenges and some additions to our work.
So from that, I think we're sort of at the end of today's webinar, but there's a couple of conclusions that we can draw from this, right? So we've laid out some reasons here today that we believe are quite compelling as to why a move to a perpetual KYC model is in firms' interests, right? Okay. Everything that we've talked about there, we talk about an enhanced risk environment, an improved customer experience, okay, which can only be a good thing for firms, and the enhancements across the data, okay, and getting more data, more and better data, and in more timely manner, okay, which allows for that enhanced risk. The control environment is enhanced. You're able to better manage the risk that firms face, and also drive out those revenue opportunities that we've talked about, okay? So there's a lot of positives that can be gleaned from this, but I wouldn't be doing my job, and I wouldn't also probably be telling you the truth if I said to you that this was going to be easy, right? It's not easy. Anything that's worthwhile is always hard. Okay, and there is going to be some hurdles to go through to get to this. Everything that Sylvia alluded to in the last line, the change in mindset, like that sort of get that tone from the top right, that's almost the most difficult bit. The technical changes are probably easier. It's the people change as ever, which is going to be difficult because it will create, uncertainty amongst people as to what a new model means. We always have to, because of the nature of know your clients and anti-money laundering, there's the regulatory aspect to it as well. We cannot ignore that. We have to be very conscious of what regulators will think. And, regulators have started to shift with that, okay? They want the money laundering directives, any of the regulations in the UK, the US, they never talk specifically about perpetual KYC, but the tone of them has started to change over the last number of iterations. They've started to talk about people having more up-to-date, timely data. And this is the sort of thing that what perpetual KYC can provide, right? So I think as the regulatory mindset starts to shift as well, firms can be moving in the right direction with this, making those changes, the mindset first, the tech changes that are needed, because this will require technology changes. There is a cost associated to it, and the restructure from a kind of an org perspective, which will lead into the operational perspective as well. All of those things need to happen, but there is the opportunity for firms to go and embrace this, okay, and see it as a way to look at the positives. It does enhance the controls that they have, and also provide them with revenue opportunities as well. All right, so our view is very clearly that the benefits here outweigh the challenges, right? And we do see, from, you know, we start to see across the market that this is a topic that people are very interested in. People want to see how they can do that and what's the best way in which they can move to do that. So we have a couple of questions, so we want to move on to a Q&A from the audience. There is a facility here for people to add questions if they would like to do so. And I think we have one already, Sylvia, don't we?
Yes, I'm checking right now. We do have a question, which is what type of entities really benefit from this? So, Owen, you want to take that one?
I'll take that one. Thank you. So the simple answer to that, and the logical one that anybody who's listened to any of this, is retail. Okay. Retail entities can benefit from this, retail banks in particular. Okay. Retail investors, retail investment firms too. Any large retail bank will have millions of individual customers. Okay, if you're reviewing them every 5 years, it's an inordinate amount of time and energy to do that, when in the main, most of those people have not moved house. They have not changed address. They still have the same nationality. Right. Okay. So the risk of those people, they're not PEPs. They're not sanctioned. The risk of those people hasn't changed. So the first use case for this really is in a retail environment. And we have actually seen that across the market, that those firms that have large retail customer bases have either moved to this or certainly are engaged in conversations with regulators to ensure the regulators are comfortable with them moving to this type of model. Now, that's not to say that those that have a more corporate customer base cannot do this either. All of the benefits that we talked about there about enhanced data and the risk management and the control environment, etc., equally apply in the corporate space as well, particularly for people who tend to deal with the likes of listed entities and whatnot, where all that information is readily available in corporate registers, and there isn't a challenge about pulling up and understanding who people are. And, you know, if anything, this is a benefit to do this, because obviously as organizations shift and management changes and whatnot, actually capturing that through a PKYC environment just enhances your risk controls. Okay, so my initial answer to that would be around the retail side, being a quite obvious place for it to do it. But I do also think there's a very strong use case for this to take place in those that have more corporate and institutional clients as well.
Yeah, and this will be linked to the access to that data that we were discussing before, right?
Precisely. Data is key to anything that we're trying to do here.
Absolutely. Let me check if we have any more questions. Yep, I don't have any more questions in the board. Owen, I don't know if you have any more questions in yours. No,
I have nothing on my side. So with that, we'd just like to thank you both very much for your attendance here today. Thank you for coming along and listening to this. We hope you found it useful and informative. On the next screen, you will see our contact details flashed up for myself and Sylvia. Any of the material that we have been presenting to you today, and this item itself was recorded, and it will be available for download via YouTube, and you should get some information from ourselves around that. But other than that, we'd just like to thank you all for your attendance, and we look forward to welcoming you back to our next webinar.
Thank you, everyone. It was a pleasure to be here with you today, Owen.